The best of money matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. Hello, I'm Hongbin Jeong. Now, the new U.S. administration has started a global trade war that will reduce U.S. and world growth, push up U.S. inflation, and delay Federal Reserve rate cuts. Now, that's according to Fitch Ratings. Now, in their recent report, Fitch has cut both their U.S. 2025 growth forecast to 1.7% from 2.1% in the December 2024 Global Economic Outlook, and their 2026 forecast to 1.5% from 1.7%. Now, these rates are well below trend and down from almost 3% annual growth in 2023 and 2024. So to find out more about their latest report, joining me now is Alex Muscatelli, who is the director in the economics team at Fitch Ratings. Alex, welcome to the show.
Thank you. Good afternoon.
Thank you so much for joining us. Alex, let's talk about, Fitch forecasts here. Fitch forecasts that the U.S. effective tariff rate will rise from 8.5% to 18% in 2025, the highest in 90 years. Is there a possibility that the ETR could surpass this level if trade tensions escalate further?
Thanks. Well, yes, I think there's a possibility of both, really. You could see a higher or a lower overall tariff level. And this is part of the uncertainty of U.S. trade policy at the moment. We have seen a lot of volatility and policy announcements on tariffs. We've seen reversals, postponements of decisions. So maybe we are a bit pessimistic in the sense that tariffs will actually be lower than what we think. But there is also a risk that you mentioned, that is, if the pattern of further U.S. tariff rises following our trading partners' retaliation takes hold. We've seen the U.S. retaliate after U.S. trading partners' actions on this. So the risks go in both directions, I think. And the combination of higher tariffs and higher retaliatory tariffs by the U.S.'s trading partners would lead to even lower output and higher prices for the world economy.
I see. Well, the report also projects 35% tariffs on China and 15% on Europe, Canada, and Mexico. Beyond retaliatory tariffs, what specific measures could these economies then take to counteract U.S. trade policies, and how would it impact Asia?
Well, one of the consequences that we saw from the trade war between the U.S. and China in Trump's first term was a diversion and an extension of supply chains. So China exports to the U.S. were often redirected through other countries. And one good example of this is Vietnam, which has become, in recent years, one of the U.S.'s top trading partners. Now, the problem is that the breadth of the unfolding tariff increases and the fact that they're so widely, and that the intention of the U.S. administration seems to be going in the direction of raising tariffs for everyone, makes this much more complicated. Now, in addition to this, how can other countries react? Well, we have macroeconomic policy too. For example, we have seen China in recent months underlining the importance of both fiscal policy and monetary policy stimulus. And we think that this will offset some of the negative impact from the tariffs. And in Europe, we have Germany changing its fiscal policy settings to allow for a large infrastructure fund of around 12% of GDP and lifting defense spending constraints. And we think this will boost growth in Germany by around 0.4 percentage points over the next 2 years, for example. Now, other offsets may not be explicitly policy-based, but could include the exchange rate. So a depreciation against the dollar could help exporters to the U.S. offset some of the tariff increases in their prices. That's another direction.
I see. Well, Fitch estimates that higher tariffs will reduce GDP by 1 percentage point in the U.S., China, and Europe by 2026. What are the implications for their supply chains then, particularly those in APAC and Southeast Asia?
Well, our macro simulations, which have informed the forecast that you mentioned, point to those types of shortfall for the main economies. But we also found that other APAC economies would be affected. So, for example, Vietnam would see even a larger shortfall than the US and China. Taiwan, a similar one to the ones you mentioned, but we would also see impacts in Malaysia, Thailand, Singapore of around zero point 0.8 percentage points in terms of the offset and the shortfall on GDP, on the level of GDP against the counterfactual of no further protectionism. And we find a smaller impact than that for Malaysia, Thailand, and Singapore. We find a smaller impact in the Philippines. Now, you mentioned supply chains. Well, these supply chains could, in some ways, especially if you have cascading tariff across borders, these could be amplified too. But I would say that from our analysis, there are two main factors that determine the impact of this protectionist turn. One is the extent of the increase in tariffs, but two is the strength of the trade links with the US or the US's main trading partners. And this is where China, given its size, given the relative size of export shares, is in GDP terms at least a bit more insulated than more open economies of Southeast Asia.
I see. I see. Well, taking a look now at the US Fed and the interest rate trajectory as well, Alex, the report predicts that US inflation will rise by 1 percentage point due to tariffs, delaying Fed rate cuts until Q4 of this year, with only one cut expected this year. In a worst case scenario, could the Fed be, forced to raise rates instead of holding steady?
Well, obviously, the tariff hikes do complicate the Fed's job. Essentially, tariffs are a supply shock, are an adverse supply shock, which moves output and prices in opposite directions. And so shocks like these make it difficult for the central bank, for monetary authorities or a central bank to respond because the signals are going in opposite directions. As you said, we have revised down the number of rate cuts that we expect. The prospect of the Fed actually raising rates, I think, is very much a tail risk because what we do expect is that you have this upward price impact, but the effect of this will be dominated by lower demand. And lower demand, because of tariffs, because of higher costs for US firms, because of higher prices for US consumers, the higher demand component of the impact from tariffs will come through eventually and will lead to a still downward path for US interest rates, but as you mentioned, at a slower pace than we thought earlier.
Well, on the note of interest rates here, Fitch expects the Fed to implement 3 rate cuts in 2026 as the economy slows. What factors could lead the Fed to cut rates faster or, more aggressively than currently projected?
Well, exactly. As I said, we think tariffs will have a slowing impact on demand, a slowing impact on the US economy. If this were sharper than expected, if this were to lead to faster weakening in US demand and US demand prospects, then we could see more aggressive rate cutting in the Fed in that case.
I see. I see. Well, with the uncertainty over trade exports, then what alternative strategies do you foresee APAC policymakers undertaking to either, mitigate declines in trade flows and sustain growth in their respective markets?
Well, as I mentioned earlier, the policy toolkit, let's say, for the US's trading partners includes domestic monetary policy, a loosening of domestic monetary policy, an expansion of domestic fiscal policy. Depending on the direction in which these would go, loosening monetary policy, other things equal, would lead to depreciating exchange rates. So maybe APAC exporters would recover some of the price rises from that through weaker exchange rates. And this is also something that we saw back in 2018-19, especially with China. So that's really the toolkit. Obviously, the policy of aggressively weakening exchange rates to recover losses in export competitiveness are complicated to implement independently. And so maybe the domestic policy options of looser monetary policy and some fiscal support could be more likely.
I see. Well, speaking of China here, China is implementing aggressive stimulus measures, whereas Europe appears more reactive. So if the trade war drags on here, Alex, which APAC markets stand to suffer more?
Well, I mentioned earlier the factors that determine the impact. It's the increase in tariffs, and the largest country affected, or the country affected by most, is China, but also the trade links with the US or the US's main trading partners. So the countries that lose most in the APAC region would be, at least according to our simulations, or looking at the starting points in terms of US's current trade policy, would be Vietnam, would be Korea, would be Malaysia, Thailand, Singapore, Hong Kong, Taiwan. Those would be the more affected countries. Other bigger economies where the US is still an important trade partner, but less so, for example, Japan, for example, India, would be less affected.
I see. Well, Canada and Mexico, they're forecasted to experience technical recessions due to their high trade exposure to the U.S. Then what strategies could APAC countries adopt to reduce their reliance on the U.S. market?
Well, already APAC countries export a large shares of their exports, especially the more advanced consumer goods. They go to advanced economies, they go to more developed economies. If you implemented some expansionary policies, for example, in Europe, that should lead to some diversion of demand. Some rebalancing in growth between US and European economies would do some of that. In terms of strategies on the macro policy side, I've mentioned some of the possible components of the toolkit. Then obviously it would also rely on what single firms and what single companies do in terms of their own strategy and their own price and industrial strategy.
I see. Well, thank you so much, Alex, for your time and your insights today.
No worries. Thank you very much. Thank you very much for having me.
Thank you. That was Alex Muscatelli, who is the director in the economics team at Fitch Ratings. This has been Wealth Tracker with me, Hongbin Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.